In this video, we will discuss a bear put spread, how to open, close, and manage a bear put spread with examples. So first of all, let's start off with Apple, and this is going to be using the Robinhood platform. Apple, I'm going to go to Trade Apple Options. So let's pretend that you think the stock will go down. You can use any ticker symbol that you wish. This is just an example. So the first thing that you'll want to do is you're going to want to buy a put option. So you are buying a put option because this is a bearish strategy. You think the stock will fall, and typically you would want to do this on a stock that is already very high. So if you think a stock is high, the strategy of bear put spread is going to benefit if the stock goes down. A bear put spread is really good in markets that are high because you can bet on the stocks going down without having to risk too much money. So first of all, you go to buy put option, and then I will give you my best practices as well. So I would buy a put option that is near the money. The reason why you would go for a near the money put is because you want to instantly benefit if the stock goes down. Now listen, you can also buy something out of the money, but here's why it's not that good of an idea. You can buy something at 172, right? In this example, this is going to be very far out of the money. The delta is very low. In this scenario, you're going to be spending money for a stock to fall down significantly. If that does not happen, you are going to lose your money. And therefore, I do not really like buying out of the money options unless maybe it's earnings or you really expect a big move in the short term. Instead, what I would do is I would buy a very close to the money put option. So here, I would buy the 185. So you will go to buy a put option, okay? And then to open up a bear put spread, you will also sell a put option. So once I click sell put, then I will buy either the next leg lower or the 2 legs lower. If I buy the leg lower, that's $250 difference. If I buy 2 legs lower, that's going to be a $500 difference. Let's talk about the benefits of a $250 spread and a $500 spread. So first of all, if I go from 185 to 182.5 and I end up buying this option, you will now see that the maximum loss here is $86. So in this example with a bear put spread, you are putting up $86 and you can make a total of $164. What you need to happen is you need the stock to go lower. So currently the stock is at 185.11. Now what you need to happen is you need the stock to go down. Your break even is 184.14 in this example. Now to reach your maximum profit, you need the stock to go down to the lower of your strike price, which is 182.5. Then you will realize your full maximum profit. So here you can basically double your money because 2 times 86 is going to be 172. That's almost a 2x return. Now let's see what happens if I don't do the 182.5 and instead I do the 180. This is still a bear put spread. So in this bear put spread example, because I'm going down a little bit more, I'm going wider, now you can put up $134. That's how much you were risking, but you have a maximum profit of $366. The reason why this is a better risk to reward ratio, or it appears to look better. So if you're a beginner option trader, you may be thinking to yourself, well, this looks a lot better. I'm only putting up 134 to make 366. But that's just not true. The reason why this is more is because there's a lower chance of Apple, the stock example that we're using, to go down to 180 in the given period of expiration, which is 6 days. Now check out why this is true. For example, if I didn't do 180 and I went down to like 170, in this scenario, the maximum loss is 179, but the maximum profit is 1,321. That may seem really, really good. You may be thinking to yourself, I can 10x my money. But the truth of the matter is, it's very unlikely that the stock is going to go from $185.11 all the way down to $170. That's because during the 6 days to expiration, there is basically almost no chance this will happen. If I expand the 170, you will see that the chance of this happening is 1.97%. That's because delta also represents the chance that the option will go into the money. So in this example, there's less than a 2% chance of Apple going down to 170 in the next 6 days, which is why this option is showing you such a huge max profit. But the chances of this actually happening are extremely, extremely low. So instead of putting up 179 to make 132, it would be much better if you were just to go down to something like 180. Because if you were to do 180, then you do get to put up less money, which is 134. Granted, it's not that huge of a difference, but in the long term, I would guess that this would be a more profitable strategy because it's more likely to occur. Now you can play around with the expiration day as well, or the strike prices. So for example, let's pick a different expiration day and let's see how that changes. So if I change from February 9th when I'm making this video, You can watch this video in the future and obviously copy the same tutorial, the same example here into the future. This is just a tutorial. So let's go to April 19th, which is going to be 76 days away from the time I'm making this video. And let's go ahead and buy a put option. Now, what I will show you is you can actually go a little bit more out of the money. So you can go for like 180. That's because there is a lot more time for this to happen. And if you are truly bearish on the stock, then it is going to go down anyways. So it makes sense for you to go down a little bit lower. In fact, let me just show you the difference. You can go for 185 again, and then I can buy the 175 strike here, and you will see that you can double your money. However, if I go down a little bit lower, it is going to be much better. So if I go to 180 and then I go to sell 170, this will be a better risk to reward ratio. And yes, I was correct. It'll go from $211 to $789. And in this scenario, this is actually very reasonable. I mean, Apple could fall to 170. The delta here is actually 0.15. There's a much higher chance that it can happen. However, your expiration day is a lot longer. But that's totally okay, because having a longer date to expiration does give you more time for something to happen in the stock. So your thesis on the stock moving a certain direction, it is much easier to go out a larger amount of time. So for example, if I get rid of the 170, I can actually go down to 160. Now this is very unlikely because I'm using Apple as an example, but now you can put up $300 and potentially make $1,700 if the stock does fall. Now I'm using Apple as an example. I would recommend for you to use a stock that has higher implied volatility. And that's because when you're buying options, which the bear put spread is, it's a buying option strategy. You can see here that it's also called the put debit spread. You're paying money, it's a buying strategy. So put debit spread or bear put spread, it is a buying strategy where you're betting on the stock going lower. And for that reason, you do want implied volatility to increase, because if implied volatility increases, there is a greater chance that the stock will move and may move in your direction. But even if it doesn't move in your direction, one of the things that I do look out for is Vega. Vega is important because if implied volatility goes up, then this option will actually increase in value. And because you are buying an option, which for example here, you're buying the 180, this will increase in value. This will also increase in value, but your long option here will increase in value much more than your short option here of 160. This is much more sensitive. For example, if we look at the Vega, it's 0.11, but here the Vega is 0.29. So because a close to the money option like this 180 is much more sensitive, if implied volatility goes up, you will make a lot more money. That's how you open a put debit spread. Now, when you close it is when you personally feel like the stock cannot go any lower. So let's say on the technical chart, the stock goes down 3 to 5% and your put debit spread makes you 15 to 20%. In that example, I may look to close this option. Now, it does definitely depend on the expiration day as well. So if I have an expiration day that is expiring very soon, then I will take profit as soon as possible. However, if I experience a 15 or 20% rise in the value of my put debit spread or my bear put spread, then I may not close it if I still have, 50, 60, or 70 days left. I will continue to ride the trend. So it really does depend on expiration. I would say you never go broke taking profit, and you definitely want to pick a profit point ahead of time. So for example, a common one that I see my students use is 50%, 75%, or even 100%. For another variation of a put debit spread I really want you to check out, I'm going to leave a video on the screen right now.